What we are going to learn today is concept of dividend policy. Understand, if there is a company X Limited, in the year 22-23, this particular company has earned or is having a total earnings, accumulated earnings plus current earnings of 100 crore rupees. This is after all the charges. So interest is paid, even government taxes are paid, and preference dividend is paid. So it is practically earnings available to equity shareholders, but it is total earnings available to equity shareholders. Try to understand, company want to take a decision how much dividend out of this 100 crore rupees should be declared. So what is the decision? How much dividend is to be declared? Dividend is declared to shareholders. Number two, rate is not fixed. Number three, it is not compulsory. Even if there are profits, it is not compulsory. We know the cost is highest, but still, dividend is not compulsory to be paid. How much dividend or how much percentage out of this earnings should be the dividend declared? Try to understand, if my company's policy is to declare 40% earnings as a dividend, 40% earnings as dividend. My dividend policy is to declare 40% dividend payout ratio. Remember, I have taught you all that dividend ratio, dividend payout ratio, dividend yield ratio. This is dividend payout ratio. So how much should be dividend payout ratio is nothing but dividend decision. And whenever we take any decision, we always come to bottom line, which is objective. What is objective of taking dividend decision? Again, it is same. Objective in all the chapters of finance will remain same. It is to maximize the shareholders' wealth. So practically, it is to maximize market price of share post after dividend is declared. Your market price of share should increase, or it should be maximum in the scenario. This is how we will decide the concept or the problem of dividend policy. Also try to understand, in finance, in basics of finance, practically there are three decisions. Financial management practically is having three decisions. One is borrowing decisions. We have already learned this, cost of capital. Leverage. This all teaches you concept capital structure. From where to borrow, from how much to borrow, everything is decided by what is the cost of borrowing. Everything is decided by this type of decisions, which are borrowing decisions. Another decisions are investment decision. Capital budgeting. Risk analysis in capital budgeting. These are the chapters in your CA intermediate which will teach you investment decision, whether to purchase machinery or not, whether to purchase company or not, whether it is financial feasible to purchase an asset or not. Those all decisions are investment decision. And third type of decision in finance is distribution decisions. If you are earning 100 crore rupees profit, how much should be distributed to owner, that is equity shareholders, and how much should be retained by company. This is covered in dividend policy chapter. So this is one of the primary chapters of financial management, which will teach you the third category of decisions, which are distribution decisions. We are going to learn dividend policy decisions, and what will be our objective? To maximize the post dividend market price of the share. That is, after declaring dividend, my MPS should be maximum. Still the same question I am asking to students. I am not asking you how much dividend should be declared. My point is, which criteria you will consider while deciding how much dividend is to be declared. Are you getting it? I am not asking you the numbers. I am asking you the points which you will consider while deciding how much dividend you will declare. So what are the points under consideration? And I want from students. Which all things you will see before deciding how much dividend is to be declared? Anyone? Yes? Market rate of return is say 20%. Then now you will decide that whether you should declare dividend or not.
If our return is more than 20, then we should not declare dividend. If our return is less than 20, then we should declare.
Okay, your R is less than 20. Alright. So you are telling market rate of return. We will discuss whether we will consider this or not. And you are also saying what I am earning, that is what my company is earning, that is R. R is not market rate of return. R is our EBIT divided by our capital employed. So it is our rate of return. Yes. Anything else which you will decide, which you will see before deciding your dividend policy decision? All right. So you are knowing chapter of dividend policy and you are telling me from formulas, but it is all right. We will discuss each and everything which should be decided. Should you not decide, see, if you will declare all 100 crore rupees dividend, in your pocket, in company's pocket, there will be nothing. If there is nothing in company's pocket, company cannot plan for future expansion, future investment. So future investment should also be one of the criteria before declaring dividend. How much dividend our competitor companies or companies in our same industry is declaring should also be considered. And I will add to one of the students' answer. We should not take market rate of return, but we should decide what is equity shareholders expectations, which is covered in one of the point, which is nothing but key. We have understood this. Expected rate of return of equity shareholders is nothing but KE. All right. Still, we know which point should be considered before deciding how much dividend is to be declared. Let me give you a concept of deciding how you will decide the exact percentage. What should be your DP ratio? What is a good decision of DP ratio? One of the students already gave the answer, but still, let me explain in detail. If my earnings are 100 crore, my question is, how much a dividend is to be declared? What is my objective? Is to maximize shareholders' wealth, ultimately maximize market price per share. Now try to understand, equity shareholders are owners of the company. If equity shareholders are owners of the company, what does this mean? Whether this 100 crore is lying with company When all 100 crores will be lying with company, if DP ratio or dividend payout ratio is 0%. What does this mean? If dividend declared is 0, then what is lying with the company? How much money is lying with the company? All 100 crore rupees? How much comes in the hands of equity shareholders? 0 rupees. But money which are lying in the company belongs to equity shareholders. It does not belong to someone else. It does not belong to Mr. X. It belongs to equity shareholders. So ultimately, equity shareholders are having a wealth of 100 crore rupees. It does not make any difference. Try to understand another scenario. If dividend payout ratio is 100%, that is the total dividend declared is 100 crore. How much money will be lying with the company? 0 rupees. How much money will be in the hands of equity shareholders? 100 crore rupees. Whether the money is lying with company or it is in the hands of equity shareholders, ultimately it is a wealth of shareholders, which will be 100 crore rupees. So first, a criteria for making decision. Whether you declare dividend or do not declare dividend, the shareholders' wealth is going to remain same, which is 100 crore rupees. Irrelevance approach. Dividend is not important for deciding shareholders' wealth, and you should forget this chapter and go ahead with increasing your EBIT rather than trying to increase your market price per share after taking dividend decision. Try to understand another concept or another rules for decision making when you are deciding how much dividend is to be declared. The same chart is correct. Ultimately, everything belongs to equity shareholders. But see, equity shareholders thinks this. How much rate of return company is earning? Let me write down in very short form. What is R for this company? We are talking about this company. What is rate of return of this company? How you can find out R? We already know. It is EBIT, that is your operating profit, divided by capital employed. So what is R of the company? Second question, equity shareholders are asking themselves, how much we own can earn from other sources. Or what is our expected rate of return? If we are having this money, how much rate of return we can earn, or what is our expected rate of return from the money? Equity shareholders expected rate of return, we write it down in short manner is KE. From the company's point of view, we write down KE. That is nothing but required rate of return of equity shareholders. This might be the return which equity shareholders is earning from the market. So what is KE? And say for this particular company, it was decided that R is 15%. Company found out by taking EBIT upon capital employed. By using CAPM model, company found out KE, which is 10%. Again, I am going to this chart. See, in this case, all the money is lying with company. So, it is better in this scenario where company on its own is able to earn 15% and equity shareholder is able to earn only 10%. So more money should be over here. If more money are over here, what will happen in this case? Try to understand. If this is the scenario, what is the scenario? R greater than KE. If 0% dividend is declared, 100 crore is lying with a company, and the shareholders will get a rate of return of R, which is how much percentage? 15%. If 100% dividend was declared, 0 rupees will be with company and 100 crore will be with shareholders. Now this money will be getting R. No, R is rate of return for the company. Now the money is not with company, it is with equity shareholders. And so this will earn rate of return only of 10%. Yes, both rate of return belongs to equity shareholders. Ultimately, money lying with company or money with shareholders are money of shareholders. But shareholders need to decide whether they want 15% rate of return or whether they want 10% rate of return. The answer will be very simple. They will want that we should get 15% rate of return on our money rather than 10% rate of return. So I am summarizing this. If R is greater than KE, what is the best scenario? 0% dividend declared, and it will ultimately result into more money with the company, and company is earning more than equity shareholders. So the best scenario will be 0%. Number 2, if R is less than KE, I am taking another scenario where a company is able to earn 10% and equity shareholders on their own are able to earn 12%. In this scenario, R is less than KE. See, what does this mean? Company is earning 10% rate of return, but the expected rate of return of equity shareholders or equity shareholders from other sources can earn 12% rate of return. What is a good idea? Money should be with company or money should be with equity shareholders? Equity shareholders. Why? They are able to earn 12% from some other place and 10% from this company. Then a better idea is to keep more money at 12%, that is with equity shareholders. Please try to understand. If 0% dividend is declared, then 100 crore will lie with company. With equity shareholders, money will be 0. This will grow only at 10%. But if 100% dividend was declared, 0 will be lying with company and rupees 100 crore will be lying with equity shareholders, and this will grow at 12%. Which is a better scenario? Growing at 10% or growing at 12%? Growing at 12%. So whenever R is less than KE, what is the best scenario? Is 100% dividend is declared. If R is less than KE, 100% dividend should be declared. Last one. If R is equal to KE, then you are indifferent. Try to concentrate. A very simple idea. Company is able to earn 10% required rate of return, or equity shareholders are able to earn 10%. Your total earnings are 100 crore rupees. Whether you keep it with company, whether you keep it with equity shareholders, it is going to grow at 10%. So it does not matter whether you declare 0% dividend, 5% dividend, 10%, 50% or 100% dividend. So if R is equal to KE, you may declare any dividend. It does not make any difference. And so in technical language, we write down indifference. So very simple concept of dividend policy. Money should be kept with a person or organization who can earn more rate of return. Let me summarize the chart once again of dividend policy decision. If company can earn more than equity shareholders, more money should lie with company. That is 0% dividend is optimal situation. If R is less than KE, that means equity shareholders on their own are able to earn more rate of return. Then all the money should be given to equity shareholders in their hand. And if R is equal to KE, both equity shareholders and company are able to earn same rate of return, you are indifferent. Please understand, declaring dividend basically means money will be in the hands of shareholders, and not declaring dividend basically means money will be in the hands of company. Now it is very simple. If company can earn more, you should declare zero dividend, and hence you will not be having anything in the hands of shareholders. Everything will be in the hands of company. If on the other hand shareholders are able to earn more, you should declare 100% dividend so that all money comes in the hands of shareholders. It is as simple as this. We are learning some of the dividend decision models. Try to understand first one. Walter's model, because it was derived by an author whose name is Walter, it is termed as Walter's model. He says post dividend market price of the share P, or I can even write down V0, value of the share today after declaring dividend. Let me write down P0. It is market price of the share after declaring dividend today. Sir, can we find out exact answer? No. Market price is dependent upon demand and supply and not by this formula. But this is how we can expect the market price of the share, whether it will increase or whether it will decrease, or what will be the new market price of the share. Try to understand. Whenever you are valuing anything in finance, we have done this in first and second lecture, it is always a present value of future cash flows. You cannot value anything in finance at cost. You will have to find out present value of future cash flows. And if you know, if there is an infinite cash flow without growth, annuity. How to find out present value? Very simple. Amount of first year divided by rate of interest. We will be keeping base of this formula and we will derive the Walter's formula, what Walter is trying to say. He says P0 will be is equal to what is earnings for equity shareholders at the end of first year. One is D1. Whatever dividend is declared is nothing but earnings of equity shareholders. But whatever is lying with the company, please understand, if earnings is 10 rupees and dividend per share declared is say 6 rupees, how much is lying with the company? 4 rupees. How we can find out E minus D? So E1 minus D1 is nothing but the money which is lying with the company per share. So what is this practically? This is dividend declared. This is nothing but retained earnings. What is retained earnings? Money which are lying with the company. And Walter says it will grow by this retained earning E minus D1 will grow by the rate of return which company is earning divided by rate of return which equity shareholders can earn. So this will grow by this money, and this will become cash flow for first year, which will continue for infinite period of time. And so to find out the present value of infinite cash flow, I will divide it by KE. I will divide it by KE. This is how I will be getting answer of Walter's model. And what answer I am getting? What Walter is forecasting? After declaring your dividend today, your market price of share as on today will be this. Before declaring dividend, it might be say 100 rupees. But after declaring dividend, this is post dividend market price of the share. And what was our objective? Remember, maximizing market price per share. So the situation in which MPS is maximum, you should be taking that type of decision. Try to understand. Let me take an example, and we'll be using this formula. And I will also explain the formula once again once we take some practical figures. Earning per share of one company X Limited is 10 rupees. Dividend payout ratio is 40%. What does it mean? 40% of earnings is declared as dividend. So D1, dividend per share, will be 10 rupees, out of which 40% is declared as dividend. So rupees 4 will be D1. Right? And your R is 15%, KE is 10%. So I can say R is greater than KE, but we have not gone to that particular idea right now. We just want to find out what is post dividend market price of the share as per Walter's model. As per Walter's model, what is post dividend market price of the share? Very simple. D1 plus E1 minus D1 into R upon KE upon KE. From where this formula has come? Numerator is cash flow for first year, which will continue for infinite period of time. So to find out present value of future cash flow, which we have divided it by KE. How to find out? The answer is 4 plus E minus D will be 6 into R is 0.15, KE 0.10 upon KE 0.10. I am finding out answer step by step. Try to concentrate. 4 is nothing but dividend plus 6 into 0.15 divided by 0.10. That is 9 rupees. Try to understand what is this. This is cash flow of first year because of retained earnings and growth. Try to understand, it is already 6. Why it is converted into 9? Because your R is greater than KE. If R is greater than KE, what does it mean? Company is able to earn more than equity shareholders. Then more and more money should be in retained earning and less money should be in dividend. So it will be multiplied by R divided by KE. So 9 rupees is an cash flow of first year which will repeat for infinite period of time. What is total cash flow of first year? 9 plus 4, 13 divided by 10%. That is 13 divided by 10%, which is 130 rupees. First, try to understand what Walter is trying to say. If you declare 40% dividend, still we have not gone to a concept what Walter is saying, how much dividend is to be declared. Right now we are doing only one procedural aspect. If 40% dividend is declared, after declaring dividend, market price of this company's share, and it is theoretical, actual market price can be determined by demand and supply. So market price of this share after declaring dividend is going to be 130. Sir, it is good or bad? We will have to compare it with different scenario. We'll have to compare it with different scenario. Try to concentrate. I hope this calculation is easy and you can easily do it. I am doing it. Try to concentrate. I am taking same example. E1 was rupees 10. Dividend payout ratio was 40%. R was equal to 15% and KE was equal to 10%. When dividend payout was 40%, what is value of share as per Walter? We have already found out. What is the answer? 130. Sir, by which formula we have found out? Very simple. D1 plus E1 minus D1 will be retained earning, will grow at R divided by KE for infinite period of time. We want to find out present value, so we divide it by KE. We use the basic formula, which is cash flow of first year divided by rate of interest, to find out present value of infinite cash flows without growth, which are in annuity. You can solve the same answer if dividend payout ratio is 0%. If no dividend is declared, how much dividend was declared over here? Rupees 4. If dividend declared is 0 rupees, once again I am calculating manually. Then my price of the share after declaring dividend as per Walter model will be 0 plus 10 minus 0 into 0.15 upon 0.10. This is common for all. Upon 0.10. What will be P0? 10, 0.15 upon 0.10 upon 0.10. Answer will be 10 into 0.15 divided by 0.10 divided by 0.10. It is 150 rupees. See what Walter is trying to say. If your KE is 10%, if your R is 15%, if you declare 0% dividend, your market price of the share after declaring dividend will be 150 rupees. If you declare 4 rupees dividend, that is your DP ratio is 40%, the market price of the share after declaring dividend will be 130 rupees. Our objective is to maximize MPS. So option number 1 is better than option number 2. Let me take first third option. If you declare 100% dividend, I am finding out by Walter's formula only. So D1 will be 10 multiplied by 100%, that is rupees 10. Value of the share after declaring dividend, theoretical value of share after declaring dividend will be 10 plus 10 minus 10 into 0.15 divided by 0.10 upon 0.10. This is 0, 0 multiplied by anything is 0. So this is 10 divided by 0.10 and answer will be rupees. Which is the best situation? Best situation is situation number 1. Why? My objective of this chapter, dividend policy, is to maximize market price of the share. And the market price of share is maximum when you declare 0% dividend. Sir, so we should always declare 0% dividend? No. What Walter says, try to understand. He says if R is greater than KE, you should declare 0% dividend. Sir, this we have already understood. Yes, the same thing is said by Walter. This is the thing which is said by Walter. This is the thing which is said by Gordon. Just the way of proving is different. So this formula is derived by Walter. This formula is not derived by any other author. But all of them says the same thing. If R is greater than KE, you should declare 0% dividend. If R is less than KE, you should declare 100% dividend. I will have to prove it, try to concentrate. If R is equal to 10% and KE is equal to 15% and E1 is rupees 10. So earning per share is rupees 10. What will be NPS if situation number 1, DP ratio is 0%. Situation number 2, DP ratio is 40% and situation number 3, DP ratio is 100%. Before finding out the answer of P0 by Walter model, all of you understand here D1 will be 0, here D1 will be 4, here D1 will be 10, right? My question to the student is, can you guess where the market price will be highest? As I have written this chart, you should be able to do it. Yes, Kushali? In third situation, the market price should be highest. I am finding out P0 under all three options, but the good point is I am having one Excel sheet where I can just fit in the numbers and I'll be getting the answers. Walter model, E1 is 10 rupees, KE is 15%, R is 10%. R is 10%. Dividend payout ratio, if it is 0%, if dividend payout ratio is 0%, what will be the market price of the share? Will be 44.44. This will directly give me the answer. You can also use the formula, put in the figures, you will be getting the same answer. Valuation as per Walter is 44.44. This will just save my time. If DP ratio is 40%, if DP ratio is 0.40, then my market price of the share will be 53.33. You can fit in numbers into your formula, you will be also getting same answer. If dividend payout ratio is 100%, if dividend payout ratio is 100%, what will be market price of the share as per Walter's model? I have just made an Excel formula where I directly get answer of Walter model. What will be P0 as per Walter model? The answer is 66.67. And so Khushali's answer was correct. Which is the best situation? If R is less than KE, 100% dividend is best situation, which is written over here. I will have to prove this. If R is equal to KE, you should be indifferent. Try to concentrate. Third situation. E1 is equal to rupees 10. R is 12% and KE is also 12%. What will be value of the share if 0% dividend is declared? What will be value of share if 40% dividend is declared? What will be value of share if 100% dividend is declared? Khushali, can you help me? What will be answer in all three cases, or where the answer will be maximum? In all three, it will be same answer? Yes, as per Walter model, all answers will be same. Because Walter says that if R is equal to K, you will be indifferent. If you are indifferent, the answer should be same in all the scenario. Otherwise, you will be selecting one option. Answer will be same in all three options. Let me find out. I'm just feeding in the R is 0.12. KE is also 0.12. If dividend payout ratio is 100%, what is valuation as per Walter is 83.33. 83.33 rupees. If dividend payout ratio is 40%, 0.40. Then also valuation as per Walter is 83.33 over here. 83.33. And if dividend is 0%, then also my valuation will remain 83.33. We are summarizing Walter model. What does Walter says is value of your share, theoretical value of the share post dividend after declaring dividend will be is equal to D1 plus E1 minus D1, that is retained earning, will grow at R divided by KE, and we want to find out present value of an infinite cash flow. So this is numerator is cash flow of first year divided by KE, because we are valuing equity shares. He also says if R is greater than KE, you should be declaring 0% dividend. If R is less than KE, you should be declaring 100% dividend. If R is equal to KE, you are indifferent. So if R is greater than KE, your maximum MPS you will get in 0% dividend. If R is less than KE, maximum MPS you will be getting in 100% dividend. If R is equal to KE, all the MPS post dividend as per Walter's model, the answer is going to remain same, which is Gordon's model. Please understand, even if any of the author is creating any model in financial management, he should value anything by only one concept, that is the present value of future cash flow. This is one of the most logical way of valuing any security. So Gordon model will also value by present value method only. But which formula he uses, try to concentrate. He says post dividend theoretical market price of the share. Post dividend, as per my opinion, that is Gordon's opinion, the market price of the share will be D1. What is D1? Dividend of first year. So he is not considering growth in numerator. See, we had considered growth in numerator as far as Walter model was concerned. Retained earning will grow at this rate, R divided by KE. He does not consider growth in numerator. What he says? D1 is cash flow of first year divided by KE minus G. You should remember something. Our eighth type of question in time value of money. What was it? Present value of infinite cash flow with growth. Right? Present value of infinite cash flow with growth. How to find out present value? Cash flow of first year divided by rate of interest minus G. What we get? Present value of all this infinite cash flow with growth. That is nothing but concept of time value of money, or how we value anything in finance. This is what Gordon is saying. It is D1 upon KE minus G, which is a basic formula of time value of money. No one can deviate from this. If they deviate, they will have to prove that this is a good valuation. So all of them will value at present value of future cash flow. See, what is this? Cash flow of first year. What is this? Rate of interest for equity shareholders. So I have taken KE. And what is this? Is nothing but growth rate. Try to concentrate. We are going to learn one new ratio. It is not a new ratio. We have already learned it. If my, say, earning per share of first year is rupees 10. If dividend payout ratio, what is dividend payout ratio? What percentage is declared as dividend as compared to earnings? So if it is a 40%, then a new ratio, understand. Retention ratio. If dividend declared is 40%, then how much is retained by the company is 60%. So how to find out retention ratio is 100 minus DP ratio, right? If dividend payout ratio is 50%, retention ratio will be 50%. If dividend payout ratio is 30%, retention ratio will be 70%. If dividend payout ratio is 0%, retention ratio will be 100%. Say I am also having Excel sheet. Let me take a dividend payout ratio as 40%. Below it, there is the retention ratio. It will be automatically 60%. If dividend payout ratio is 25%, retention ratio will be 75%. If dividend payout ratio is say 5%, then retention ratio will be 95%. So concept of retention ratio should be absolutely clear. And try to understand what Gordon says about this, which is G. Let us understand G in Gordon's model, which is nothing but growth rate. He says company will grow because of retention. Because of retention. And what is B? Is nothing but retention ratio. What is DP ratio? Dividend payout ratio. What is the name of retention ratio? In short, we term it as B. So company will grow because of retention ratio. But retention is important if the company is earning some rate of return. So he says retention ratio will be B into R. whatever, and it is logical. Understand why you have growth in your company, because you are having some accumulated money which will grow at our rate of interest, so your growth will be B into R. Suppose my retention ratio is 40% and my R is 15%. What will be the answer? Is 15 into 40 percentage, which is nothing but 6%, which will be nothing but my growth rate. So Gordon says your growth rate is nothing but retention ratio multiplied by return on capital employed, which is nothing but R. So another formula which we'll have to learn when we solve the questions of Gordon model. What is it? B into R. And what is a B? It is nothing but retention ratio. And still we have understood post dividend market price of the share. We have understood how to find out growth rate, but we have not understood concept of Gordon's model. Let me take one example. Say E1 is a 10 rupees. R is a 15%. KE is a 10%. What if this company is declaring, situation number 1, these are not the same questions, they are different questions. If company is declaring 10% dividend, if company is declaring 60% dividend, or if the company is declaring 90% dividend. Say 100% dividend. R is greater than KE. What should be the good idea? 0% dividend, right? Or minimum dividend. At 10% dividend, what will be D1? It is a 10 into 10%, that is rupee 1. At 60% dividend, what will be D1? Is rupees 6. At 100% dividend, what will be D1? Is rupees 10. What will be retention ratio in this case? Is 90%. What will be retention ratio in this case? Will be 40%. Retention ratio is B. We have understood, right? 100 minus 60%. 100 minus 10%. 100 minus 100%. So retention ratio will be 0% or 0. Right? So B is 90 over here, B is 40 over here, and B is 0 over here. Let us find out market price of the share post dividend by Gordon's model under all three cases. He says P0 is equal to D1 upon KE minus G. What is D1 in this case? 1 rupee. What is KE? 10%. Minus growth rate. I will have to find out G. G is equal to B into R. What is R? 15%. So 15% into retention ratio is 90%, which is 13.5. The answer is going in negative. Right? So the Gordon is unable to give you the answer. Let me take a point whereby say my KE is 14%. Let me change KE so that I don't get negative answer. Right? So what will be the answer? Answer will be 14% minus G is 13.5. That is 0.5%. Will be 1 divided by 0.005. That is rupees 200. Still R is greater than KE. R is greater than KE. If a 6 rupees dividend is declared, let me first find out growth rate. B into R. B is 40 into R is 15%, which is 6%. Let me find out P0. P0 is equal to D1 upon KE minus G. D1 is 6 rupees. KE is 14% minus 6%. This is 6 divided by 8%, which is 75. Will be market price of the share as per Gordon model. I hope all of you understand how I am finding out G. Retention ratio is 15% multiplied by, or growth rate is multiplied by 0, so growth is 0. There is no growth rate. P0 is equal to D1 upon KE minus G, which is 10 divided by KE is 14% minus 0%, which is 10 divided by 14%, which is 71.4. Which is best scenario? Best scenario is the situation number 1, where your market price of the share after declaring dividend is highest. So it is scenario number 1. I am trying to summarize Gordon. Gordon says if R is greater than KE, I am not writing 0% dividend. Why? I try to understand. If this becomes a 0, the answer will become 0. So I am writing the answer minimum. As minimum as possible. Gordon says if R is greater than KE, same thing. Company can earn more than equity shareholders. More and more money should be with company. If you want more and more money with company, you should declare less dividend. So you should declare minimum dividend. And we have proved it, right? At 10% dividend, your answer will be minimum and your NPS will be maximum, and you should opt for situation number 1. If R is less than KE, I will have to take an example, say a similar type of example. E1 is equal to 10, R is 14% and KE is 15%. If 20% dividend is declared, situation number 1. Situation number 2, if 60% dividend is declared. And situation number 3, if 100% dividend is declared. Alright? Yes, I want one answer from the student where the answer will be highest. R is less than KE. In third option, it will be highest. Let me first write it down. If R is less than KE, Gordon suggests maximum dividend. Here it was minimum dividend policy. Here maximum dividend policy. Let us prove it. I can easily prove it because I am having an Excel sheet where I just need to fit in the numbers. Gordon model, E1 is 10 rupees. R is 14%. R is 0.14. KE is 15%. I have already written 15%. And in first case, dividend payout ratio is 20%, 0.20. If dividend payout ratio is 20%, retention ratio will be 80%. R is 14%. So growth rate will be 11.20%. How I found out growth rate? This, it is B into R. What is B in this case? 80% into R is 14%. I will be getting 11.2. So I have found out growth rate and I have written the formula in such a manner I directly get valuation as per Gordon. This is value as per Gordon, which is 52.63. If dividend payout ratio is 20%, the value is 52.63. If dividend payout ratio is 60%, If it is 60%, the value will be 63.83. And if dividend payout ratio is 100%, the value will be 66.67. Where it is highest, as told by one of the student, it will be highest in situation number 3. I can prove that if R is less than KE, maximum dividend should be declared. In this case, 100% is maximum. So we will be getting P0 maximum in situation number 3. And if R is equal to KE, you should be indifferent. I am proving it last time. E1 10, R is 12%, KE is 12%. If 30% dividend is declared, 60% dividend is declared, and 100% dividend is declared, what will be answer of P0? Answer should be same. To prove my theory, answer should be same. Let me fit in the numbers. E1 is 10, R is 12%, and even KE is 12%. If dividend payout ratio is 100%, P0 is 83.33. If dividend payout ratio is 60%, then my answer still remains 83.33. And if dividend payout ratio is 30%, my answer still remains 83.33. Hence proved, if R is equal to KE, whether you declare dividend, whether you declare 10%, 20, 60 or 100% dividend, your value of the share post dividend is going to remain same. Dividend will not affect your company. This is two basic models. 95% of the questions asked from dividend policy, every time 5 marks is of dividend policy, is always either from Walter or from Gordon. There is another one more method of finding out dividend policy, and let us do that. It is Graham and Dood method, or it is also termed as a traditional method. Which is traditional method. He says your value of the company post dividend will be is equal to a multiplier. I'll explain you what is multiplier. As it is multiplier, it will be multiplied by your earnings portion. See, what does it say? He says, find out a multiplier. Say if this is like PE ratio, MPS divided by EPS. If your earning is a 10, every time your market price is 100, if your earning is 5, your market price is 50, that means your company's multiplier or PE ratio is 10, right? So find out multiplier of your company on your own. As a student, it is very easy. If this method is asked, you will be given M. You cannot find out M on your own, right? So the multiplier should be given, M will be given. Multiplied by your earnings. And what are your earnings? Dividend and earnings. Both are your earnings. But Graham and Dood says that dividend will impact more because it is a current scenario. Your earnings are in future. Dividend is a current scenario. So whenever you multiply it with your multiplier, what earnings should be multiplied? Dividend will create one impact, but earnings will create only 1/3 impact, right? So earnings will create less impact because it is going to impact in future. but your dividend will create more impact. So it is 1D plus 1/3 of E. You will be getting answer of P0. He does not suggest R greater than KE, R less than KE. He just says if you want to find out post-dividend market price of the share, find out one multiplier, multiply it with earnings, and how to treat your earnings as a dividend as one full portion and earnings as 1/3 portion. This is Graham and Dood or traditional method. Let us go to fourth method or fourth approach of dividend policy, which is Modi-Giuliani-Miller approach of dividend policy. He is the same person who has written Modi-Giuliani-Miller approach in capital structure. Capital structure MM and this MM are same. The persons are same. What is said in capital structure? Deciding how much to borrow from equity and how much to borrow from debt. The proportion of debt and equity is not important for determining value of the company. This is what is said in capital structure. The same type of thing is trying to say over here. Not same type, same thing is saying over here. He says dividend policy is not relevant for market price of share or post dividend market price of the share, or is not relevant in decision making. Try to understand in broad way. He is trying to say this. If you are earning 100 crore rupees, to decide how much should be declared as dividend, how much should be kept as retained earning, this is what we are deciding in this chapter, is not important. This is just distribution. If I am doing my own business, how much I will keep cash in my business or how much cash I will bring it at home is not important. What company should do is try to maximize your earnings. Instead of wasting time in deciding how much should be declared, how much should be retained earning, he says try to increase this portion, that is 100 crore rupees, try to make it 200, try to make it 300. Rather than deciding where to distribute this earning, concentrate on your earning. This is the very simplest way of understanding MM approach. He says dividend is not relevant for deciding post-dividend market price of the share. And hence, this again, in dividend policy also he has given irrelevance approach. What does he says? What he says is what normally student says. If student finds some chapter difficult, they normally keep it in doubts or they skip it. They say this chapter is irrelevant. This chapter is not important. And that is the same thing what MM says in capital structure also, in dividend policy also. Dividend policy is irrelevant in financial decision making. But he does not say this because he feels that the chapter is difficult. Try to understand, he will have to prove it. This is not psychology where you can say this is mind, this is logical, and so this will work. He will have to prove it mathematically, and he proves it mathematically. What he says, try to understand. Value of the shares. Now, whether the person is Walter, Gordon, or MM, he cannot violate the concept of finance. He will have to use the concept of finance and find out value of the share or value of the company. So he cannot ignore the concept of present value of future cash flows. And believe me, he still uses the concept of present value of future cash flows. How? D1 plus P1 upon 1 plus KE. Sir, this is present value of future cash flow. Yes. Try to understand. If I purchase Reliance today, what will be my income in first year? Say 5 rupees. This is dividend per share. What will be my income for first year? 5 is dividend, right? Dividend per share. I have got 5 rupees. if I sell this share after 1 year, I will be getting market price of the share after 1 year, which is say 100 rupees. So what is a D1 P1? It is a cash flow after first year. What will be cash flow in second year or income in second year? Zero. Why? You are assuming you are selling the share after first year. So in second year, you will not be earning anything. The cash flow will occur only for 1 year. How? Today you will purchase it. After 1 year, you will sell it. So after 1 year, you will be getting dividend and P1. This is cash flow of first year. How to discount cash flow of first year? Into 1 divided by 1 plus I raised to 1. What is I over here? KE raised to 1, you can cancel it. What is cash flow of first year? D1 plus P1. What is 1 plus I is nothing but 1 plus KE, which is nothing but this. has used present value of future cash flow to determine the price of the share. Alright, so I am starting with, so let me use this formula as my base. P0 is equal to D1 plus P1 upon 1 plus KE. Try to understand when started his approach, he is very worried. Why? Because of this. See, dividend should not form part of the formula. If dividend forms part of the formula, that means dividend is relevant. But he wants to prove irrelevance. So dividend should go out of this formula. And he cannot just cancel it. He will have to technically remove it. And try to understand. Can I multiply n on both the sides? N is nothing but number of shares currently. Can I multiply n on both the sides? Yes, it will be n into P0. Now if P0 is the price of one share, then n into P0 is price of all the shares. That is nothing but value of the company. Is equal to ND1 plus NP1 upon 1 plus K. I hope you understand. If n is out of the bracket, you will have to multiply n with D1 also and n with P1 also, but in numerator, not in denominator, because on left hand side also I have multiplied it with numerator. Try to understand. This is NP0. Now what I am doing? ND1 plus NP1 upon 1 plus K. Can I add delta N P1 over here? No. In equation on right hand side, in numerator, you cannot add any figure, right? But you can add it if you subtract it at the same time. I will tell you what is delta N P1. But in mathematics, I can do this. In numerator, I can add 2, subtract 2. But I cannot only add 2. I can add 5, subtract 5. I can add 100, subtract 100. In numerator, I can do this. So I am adding delta NP1 in numerator and reducing delta NP1 in numerator. What is delta N and P1? Try to understand. P1 is nothing but expected price of share after 1 year. And delta N will be new shares that will be issued after 1 year. They are not total number of shares. They are new shares which will be issued after 1 year. After 1 year, share will be issued at what price? P1. So understand what is delta N into P1. That is money which will be raised after 1 year from issuing new equity shares. How many equity shares? Delta N shares. So this will be total money raised or total money borrowed by issuing new equity shares after 1 year. That is nothing but delta NP1. That is added and subtracted over here. Now, how much money should be raised after 1 year? What is required should be raised after 1 year. What is required is your total investment. Say after 1 year, I want to make investment of 100 crore rupees. Then you will require 100 crore rupees. After 1 year, I will be having investment of 500 crore rupees. Then you will require 500 crore rupees and you will raise 500 crore rupees. So what should be money borrowed after 1 year is investment. But you are already having some money. That is nothing but total earnings of current year. This money you are already having it, so you need not borrow it. Very simple, try to understand. If your investment is 100 crore and if your total earnings are 60 crore, you will have to borrow only 40 crore rupees, right? So it is investment minus total earnings. But if you are having total earnings, that does not mean it is with you. It might have been declared as dividend. So this money totally is not lying with you. It might have been declared as dividend. So whatever is declared as dividend, I will have to subtract it. It is nothing but a total dividend. And this is how much money I will total raise after 1 year. This is delta and P1. I am making it in short form. Investment is I minus total earnings is E. This is not earning per share. It is total earning. You can even write down TE, which is total earnings. Minus. What is the D1 is nothing but dividend per share. D1 is dividend per share. Now I cannot write down D1 as total dividend. So D1, that is dividend per share, multiplied by number of shares. That is the total dividend declared, and D1 is nothing but total dividend. And so I am summarizing it. I'll open the bracket, the sign will change, minus total earnings plus ND1. This is the delta N P1. Concentrate what I have done over here. I have added delta NP1 and subtracted delta NP1 over here. Let me do it in this equation itself. Plus delta NP1 minus delta NP1. I am rewriting it. NP0 is equal to ND1 plus NP1 plus delta NP1 minus, what should be written? Delta NP1. Instead of delta NP1, I am writing this. Can I write down this instead of delta NP1? Yes, because it is nothing but delta NP1. Minus I minus total earning plus plus ND1. So instead of this, I have written what we have derived. That is I minus total earning plus ND1 upon 1 plus K. Let me solve it. NP0 is equal to ND1 plus NP1 plus delta NP1 minus I. I'm opening the bracket, so all sign will change. Plus total earnings minus ND1 upon 1 plus KE. And see the geniusness. Normally I see student who says MM is very difficult. It is not difficult. He is genius. What was the problem D1? Believe me, now it is removed. ND1 is positive, ND1 is negative. So D1 is removed. Whatever might remain, but D is not remaining. D is dividend, and he says this is value of the company. P0 is price of one share and P0 is the value of the company. So he says value of the company will be is equal to NP1 plus delta NP1 minus I plus total earnings upon 1 plus KE, and there is a magic happening that D1 is removed, and hence he proves his theory that dividend is not relevant for determining market price of the share. And I can even summarize this as is equal to P1 I can take common, N plus delta N, I have solved this too, minus I plus total earnings upon 1 plus KE is nothing but NP0. Right. So I will be getting idea of MM approach. What is MM approach? He says dividend is irrelevant for determining market value of the firm or market price of the share. How he proves it? He starts with taking the present value of future cash flow formulas, and ultimately by magic or by mathematics he removes D1. So he proves that dividend is not relevant for determining market price of the share or market value of the company. Sir, if the question is asked, rarely a question is asked of MM, because if you want to find out NP0, you can directly take NP0 and find out NP0, right? But if some questions are asked, sometimes it is told to prove that market price of the share will remain same or market value of the firm will remain equal, whether dividend is declared, whether dividend is not declared, then these three formulas are important. First, P0 is equal to D1 plus P1 upon 1 plus K. Another is of delta NP1, which is nothing but this. It is I minus total earnings plus ND1. This is how we find out delta N, because we will be having P1, I, total earnings and ND1. So we will be able to find out delta N. You can also summarize this as delta N is equal to I minus total earnings plus ND1 upon P1. First one, second one, and the third one, final formula. What will be NP0? NP0 is nothing but value of the company. It is P1 delta N plus N or N plus delta N. Let me write down N plus 2. N plus delta N plus I it is minus I plus total earnings upon 1 plus KE, and you can see in the last formula your dividend is removed. Hence MM proves that dividend is irrelevant for determining the market value of the company or market price of the share. We have done all the methods of dividend policy, where first was Walter, second was Gordon. Both of them said the same thing. If R is greater than KE, 0% dividend or minimum dividend. If R is less than KE, 100% dividend, and if R is equal to KE, you are indifferent. Where Walter used the formula of P0 as D1 plus E1 minus D1 R upon KE upon KE. Gordon used the formula P0 is equal to D1 upon KE minus G, where G was equal to B into R. Otherwise, they both proved the same thing. Third method was Graham and Dood. Where he just said it is multiplier into earnings. And what are your earnings? D1 plus E1 upon. And fourth, last but not the least method was approach of dividend policy, who said initial your price of the share will be D1 plus P1 upon 1 plus K. You will issue new equity shares, which is I plus E, total E, minus ND1 upon P1. This is how many new shares you will issue. And finally, the value of the company will be P1 N plus delta N plus minus I plus total earnings upon 1 plus. And he says dividend is irrelevant for decision making. So Walter, Gordon, Graham and Dood are relevance approach. Is irrelevance approach for dividend policy decisions. Let us take one example for approach. A company, say XYZ Limited, was having 10,000 shares. Face value rupees 100 and today's market price of the share or P0 is also 100. Required rate of return of equity shareholders is 12%. Total earnings 5 lakhs rupees. That is current year's total earnings is 5 lakhs rupees. New investment is rupees 10 lakhs. What is the value of the company? Whether the value of the company will be same or not, if no dividend is declared. That is D1 is equal to 0. And option number 2, if 20% dividend is declared. In both the cases, we need to find out various answers, prove that the value of the company is going to remain same. I am using first option, finding out various answers. P0 is equal to D1 plus P1 upon 1 plus KE. What is P0 given? What is D1 0? What is P1 not given? What is 1 plus KE 1.12? If you solve this equation, what will be answer of P1 is 112 rupees. So market price of the share after 1 year will be 112 rupees. What is the delta N? We have solved this. It is I. Let me see the formula. I plus total earnings minus ND1 upon P1 is number of new equity shares that will be issued. What is investment for next year is 10 lakhs. total earnings is also given 5 lakhs. Minus ND1. D1 is 0, so ND1 will also be 0. Divided by P1, that is 112 rupees. I will keep it not in decimal. This is 5 lakh rupees divided by 112. I am finding out the answer, but I'll use 5 lakh divided by 112. It is 4464 approximately. Number of shares new will be issued after 1 year. What is NP0? Try to concentrate. What is NP0? What is NP0? Value of company today after declaring dividend. What does MM says? It is the P1 into N plus delta N minus I plus total earnings upon 1 plus K. What is P1 is 112. What is N is number of shares 10,000 plus delta N is 5 lakh divided by 112 minus I is 10 lakhs plus total earnings is 5 lakhs divided by 1.12. Totally divided by 1.12. This answer is 112 multiplied by 10,000 plus 5 lakh minus 5 lakhs. 11 lakh 20,000 will be numerator divided by 1.12, which is rupees 10 lakhs. This is value of company after declaring dividend, which is nothing but NP0. Now, why those questions are removed and they are no longer asked in examination, I'll tell you. This answer can be found out without using this formula. You can see left hand side. What is left hand side? NP0. What is number of shares? 10,000. What is P0? 100. So NP0 will be 10 lakhs rupees. So whether you use this formula or do not use this formula, you are having left hand side and N is also available, P0 is also available. So you can always find out the answer. But yes, they can ask you a question of 5, 6, 7 marks that prove that the value as per MM will be same. Then you will have to prove by this formula. Let us first prove it. Option number 2. 20% dividend is declared. What is first EPS 1? What is total earnings? 5 lakhs divided by number of shares 10,000. So it is 50 rupees. How much dividend is to be declared? 20%. So rupees the 10 will be nothing but D1. D1 will be 50 into 20%, that is rupees. Let me use different formulas to find out the answer. P0 is equal to D1 plus P1 upon 1 plus K. P0 is 100. D1 is 10 plus P1 upon 1.12. So P1 will be 112 minus 10, that is rupees 100. Let me find out delta N. Delta N is I minus E plus ND1 upon P1. I is a 10 lakhs minus 5 lakhs plus N is 10,000 multiplied by D1 is 10. So this is 1 lakh rupees upon 102. 5 lakh plus 1 lakh is 6 lakhs rupees divided by 10 will be delta N. You can also find out answer and write down this is number of shares new to be issued. Let me find out. 6 lakhs divided by 102, approximately 588. What is NP0 is equal to P1 102 N 10,000 plus delta N 6 lakhs divided by 102 plus minus minus 10 lakhs plus 5 lakhs whole upon 1.12. What will be answer? I know it should be 10 lakhs because on left hand side it is an NP0. So this will be 102 into 10,000 plus 6 lakhs. 102 will be cancelled. Minus 5 lakhs divided by 1.12, which is rupees 10 lakhs. This is value of the company. If dividend is declared, the value of the company is going to remain 10 lakhs. If dividend is not declared, the value of the company is going to remain 10 lakhs. Irrelevance approach. So dividend policy is not important for financial decision making. This is what Modigliani Miller says, and you should appreciate he has created a formula where NP0 is without D1. This is nothing but a question of MMM.